All right, everybody, welcome back to the Small Axe Podcast, where I show you how to build a lasting empire with your small axe. I want to talk a little bit about what's happening in today's market in 2025, what to expect, what you should be doing, and how you can crush 2025 and become a sick, serious, dope multifamily investor. All right, so there's a lot of noise out there saying that multifamily is dead, interest rates are killing deals, or like now's not the time to be investing, it's the worst time to be investing. But guys, come on, stop it. Opportunity is out there. You just need to know where to look, how to adapt, what to take down, what to do, when to be aggressive, when to pull back. So today we're going to talk a little bit about where the market stands right now, interest rates, cap rates, investor sentiment, best markets to invest in, smart strategies to find and fund deals in today's environment, how to position yourself for long-term success while others sit on the sidelines, and that is a failing mindset. Don't do that. So let's jump in. Okay, where are we now? Let's start with a market reality check. Here's what's happening in multifamily investing right now. Interest rates and lending conditions. No surprise. If you have been reading the news or been up to speed with anything, the Federal Reserve held interest rates steady in early 2025, with the Fed funds rate still hovering around 5.25, 5.5, the highest in over 20 years. Most lenders are issuing loans around 6.5, 7.5% range, which means that debt is still expensive, and DSCR, the debt service coverage ratio requirements, are tougher than ever. LTV, loan to value ratios, have tightened as well. So banks now prefer 65%, maybe 70 if you're lucky. I always underwrite for like 63% just to be safe, forcing investors like me and you to bring more capital down to the table at the closing table. It's important to know you have to come out of pocket with more money these days, okay, just to hit that DSCR based on the new lending requirements, based on the higher interest rates. It just is what it is, gang. Cap rates, valuations in 2021, 2022. We were seeing C-class properties trading 4 and 5 cap, 4 and 5% cap rates. That's crazy. Now, cap rates have expanded to about 6.5, or even 6.75 for C-class properties. B-class is 5.5, 6%, according to CoStar. Okay, so these are just some data points that you should be looking at and considering. Now, what does that mean for me? That means opportunity, because you're buying it at a discount. If you're buying a property, let's say a B-class property at a 6% cap rate, which in 3, 4, 5 years could be a 5 cap, that's a deal, okay? And it could be even better than that. So valuations have dropped 15, 25, even 40% from the peak pricing in 2022. If you bought at the top, like me, you're feeling the pain, but you have to adapt. You have to understand what to do, how to get around these obstacles, how to still have your property perform. And that's what we are working on right now in my portfolios. We're doing pretty good. There is an opportunity to negotiate better deals, okay? If you can get a higher cap rate for a same product that you would have paid a lot more for a year ago, or let's say you're getting a 40% discount from a few years ago, that's a huge deal. That's an opportunity. Let's talk about investor sentiment right now. Private equity and institutional investors are hesitant to deploy capital, but that doesn't mean that the market is dead. There are individual investors. There are people out there that you should have been speaking with over the years that are still ready, still looking to drop some cash into deals. It's important for us as investors to put our money to work. Our capital has to be working for us. We don't leave it sitting in the bank. Now, the challenge for us as multifamily investors is we're seeing people can get 4 or 5% on very safe investments like T-bills, money market funds, or even a high interest rate savings account. So we have to compete with that. So the expectation must be for our investors that we can provide them with at least a 5% cash on cash return. And that's difficult to find in today's market. It's always been difficult to find since I've been a multifamily investor for the past 5 years. Prior to that, maybe it was easier. Today's day and age is not. So the market has popped. So what's the key takeaway here? The easy, frothy market of 2021-22 is gone. Now's the time for disciplined investors, operators, people out there to get creative and find the undervalued opportunities. If you can take over a property and fix inefficiencies, not necessarily CapEx, you're at a win. If you can buy that property at a discount, not have to put much money into it, barely renovate, if you can fix operational inefficiencies, buying at a discount, getting cash flow of 5%, you are golden. That's what you need to look for. Forget about an 8% cash on cash. It just doesn't happen unless you're in maybe Cincinnati or some cash flow markets, but not in the markets that I'm in. If you can find cash flowing properties in an appreciation market like the Central Florida area, you're golden. Now, best markets for multifamily. So I'm not a pro on all these markets, but I do occasionally research, and I'm going to talk a little bit about some of the markets. Not all markets are created equal. Some outperform others. Things that you have to look out for are where people are moving, where there's job growth, where it is affordable still, where there is landlord friendliness going on. So these are the things we look for as multifamily investors. So number one is actually Orlando, Florida. Job growth is 4.5% year over year. So the surrounding areas of Orlando is where I invest. Polk County, Orlando's right there, right next to it. Strong tourism, tech center, high rent growth, etc. Dallas, Fort Worth, always at the top. 300 plus people moving in daily. Job market still booming. Strong demand. Charlotte, North Carolina, one of the fastest growing metros. Great for B-class workforce housing. Phoenix, Arizona, another strong house. Rent growth slowed, but long-term fundamentals are still strong. Indianapolis, guys, more affordable than the hot Sunbelt markets. Great cash flow potential. Consider Indianapolis. Now, which markets to be cautious about? I am sure there is no surprise here when I say San Francisco, California. There's rent control, there's tech layoffs, there's high vacancy. New York City, where I live, high taxes, strict eviction laws. Guys, you can't get people out. It's crazy. Softening demand in some of these submarkets. Austin, Texas, okay, high supply of new apartments causing rent stagnation. And the supply also hurt us in Lakeland. We had too much supply come to market in 2024. It is being absorbed now. 2025, 26, 27 should be epic, hopefully, for us down in Lakeland, Florida. Key takeaway: invest where there is population and job growth, affordability, and business-friendly laws. This is what you want to do, guys. You want to find markets that have encourage small businesses, where people want to move, want to live, where the weather is nice. Maybe they have some storms come in, but nothing crazy. So where we invest in Central Florida, the tropical storms, the hurricanes don't necessarily have the same impact as they do on the coasts. That's important. We can get better deals for insurance, and we have less risk when a giant hurricane does hit, which we saw with Milton and Helena back in the fall of 2024. We sneaked away with barely any damages on those storms. Let's talk about some strategies to find and fund your deals in this softening market. Off-market deal flow is always crucial. Now, I am not a pro at it, but I do have cold callers from time to time calling for me. I do search Facebook Marketplace. I do search, rather, Facebook groups. I do talk with daisy chain brokers, although I don't love that concept. I do talk with brokers that are brand new or starting their own firm. I do talk with wholesalers as well. Now, brokers aren't handing out great deals right now, but they are still the ones doing all the calling. Okay, so if you don't have a cold caller and you can't afford a cold caller, or you don't have the time to do it yourself, you got to go with the brokers. Just find the right brokers that are going to work with you. Remember, if brokers are not contacting you back, there's an issue. They just don't trust you as a buyer. I have a combat for that. I have my credibility kit, which is now available. You can download it from my website if you sign up for my mailing list, or you can go to my YouTube channel and you can find my one pager, and it's in my credibility kit as well. The credibility kit has everything you need to talk to brokers and find deals. My one pager is available on my YouTube channel. You can download it from Canva. You get your own copy, and I show you exactly how to edit it and provide it to brokers. It is, how you say, epic. You're going to love it. Use direct mail, do cold calling, go to local networking events, find distressed owners willing to sell, continue talking with owners, even if they say no. I negotiate for years and I fail all the time, but you never know. You might get one. You got to continue those relationships. You got to continue the conversations. Look for loan maturities. There is data out there that you can find loan maturities coming due in 25 and 26, where there's huge amounts of loans coming due. That doesn't mean that there's blood in the streets, but people might be willing to sell and potentially at a discount if their loan is due and they can't get a refi and they don't want to do a cash in refi. Think about some sort of creative financing strategy. So seller financing is making a comeback. If a seller has a 3 to 4% loan, they may be open to creative terms. Assume people's loans, right? Some deals still have sub 4% debt that you can take over, reducing your financial costs. If a seller offers you seller financing, maybe no money down, be willing to offer them more in a purchase price. You don't have to come out with any money. That's huge. But remember, if you are putting money in towards CapEx, most likely, depending on the property, obviously. But if a landlord or an owner doesn't have any debt on the property, they probably have owned it for some time, and there is going to be some deferred maintenance. You need to really know that before getting in. Value add still works, but be smart. Don't just renovate blindly. As a matter of fact, I am telling most of my colleagues not to renovate. Even if you have money to renovate, you want to hold off for now, for the time being. You want to wait until brighter days. And if people are willing to pay more, then what you do is you upgrade 3, 4, or let's say 5% to 10% of the units, however many that is, of your overall units. You upgrade them to show that you can get a rent bump. And this is a proof of concept that the next buyer would be potentially willing to pay for as a premium. So you give them the proof of concept, and they come in and take over, and they do the renovations for you. Now, avoid over renovating today, which is important. So stick to cost-effective improvements, just maybe deep cleaning, things like that at unit turns. Don't get crazy today because it's not necessarily the strategy that you want to be using. Let's move on. Adapting for long-term success, hold or flip. If you're in a high interest rate environment, flipping might not make sense. Focus on long-term value creation. Cash flow, as I always say, cash flow nowadays is king. Don't chase appreciation alone. You have to make sure that the property is cash flowing. You don't get rich off of cash flow, but it's a safety net. If you run into issues and the property is cash flowing, you should be fine. If it is not cash flowing, you're going to come out of pocket, and we need to avoid that at all costs. Build recession-resistant portfolios. A and B class properties in growing metros are safer than C class deals in declining markets. Diversify your income streams. Think bulk internet, laundry services, pet fees. Maybe consolidate. What we're trying to do in our 44 unit is get an in-house maintenance tech, which will hopefully reduce our costs in half. That's our goal, and that's what we're shooting for. And we just started this month. So far, so good. I will keep you updated on that. And be prepared for the next market shift. So cap rates could compress by 2027, which means buying now at a 6 or 7 cap rate could set you up for a big win later. Now, don't be afraid to get out there. Don't be afraid to be making offers. In fact, you should be making offers. Just make offers on what makes sense to you. If a broker says you're too far off, say, okay, this is where I feel comfortable. And you never know. There are so few buyers out there that many brokers are showing these offers, the low offers that I'm making to the sellers, and the sellers are saying no. But you know what? What happens in 2-3 months from now when they get no other offers? They're going to reconsider my offer. Be in that position. Continue offering on deals just as long as it makes sense for you. You got to be a little conservative these days, and that's okay. We always spoke about in 2021, 22, oh, we're so conservative. We have conservative underwriting. God, I hate that. I hate that term, conservative underwriting. You really have to be conservative. And the only way to be conservative is if you know how properties should be operating. So if you're an operator and you're actively operating deals, you know how they should and could be operating. So then you can be conservative when you make your next offer. Here's the bottom line, gang. Multifamily investing is not dead at all. It's just different. If you understand today's market conditions, you can still find amazing opportunities while everyone else is scared to pull the trigger. Don't do that, guys. Continue to stack your deals. Continue to put them on the conveyor belt. Know that this is going to take you 10 plus years, think in decades, and that's okay. Here's some top 3 takeaways from today's episode. Interest rates and cap rates have shifted. This creates buying opportunities if you structure deals correctly. Invest where people are moving, where jobs are growing, and where there is diverse economy. That's where demand will stay strong. Use creative financing. Go direct to seller and do smart value add strategies, meaning very minimal upgrades. Do not over renovate today. There is no point. These are the keys to winning in 2025. If you want to go deeper and you want to learn more, you can go to my website, smallactscommunities.com. Get my free multifamily credibility kit, where this will help you get credibility with brokers today. Guys, don't sleep on this. You have to do it. It's free. I've been giving this out since 2020. I never created anything for it. People would just call me. I'd have a meeting with them. Kind of a waste of time, to be honest with you. show them how to do it. Now I finally made like a little PDF with videos and supplemental activities and stuff just to give you. So you don't have to get on a meeting with me. Just go to my website. You'll get this free multifamily credibility kit. Start building your relationship with brokers today. Subscribe to my podcast, please, if you have not. I don't want you to miss any future episodes. If you feel like my podcast helps you, I would really love it if you would share it with those around you, those people that you think might get benefit from it as well. I pour my heart and soul into these episodes. I do one episode a week. Guys, I have 4 jobs in my life. I am doing this because I love it, because I want to help you. This is my goal. I am a teacher by trade. I want to teach. I want to help. I want to watch people succeed and build and create lives that they would love to live. Now, until next time, keep chopping away. Love you guys. All right, and that's a wrap, Small Axe community. So I wanted to take a minute to say thank you so much for listening to the show. And if you liked it or got any value from it, it would really mean the world to me if you would share it with someone else and write a review. Remember, guys, keep sharpening those axes. Let's get out there. Let's crush it. Love you guys.